Hi everyone, this is Bag of Dawn at StockMarketCaddy.com. It is November 17th at 11 a.m. And if you just watched an earlier video on the dynamic yield curve, I just caught a couple of errors and I just wanted to correct them, so I'm reposting this. But for those of you that are coming across this video on YouTube, please know that we have you can follow us on Twitter. You can also follow us on our webpage, and we have a subscriber group, a private club, if you will, where we provide market commentary every Sunday night on the markets on a weekly and at appropriately the monthly basis. And then we also provide a video view of the markets based on what we call our swing machine each and every morning for active traders and investors. And our swing machine is based on tens of thousands of hours of trading our own money. It's an objective, non-biased system that provides us trading opportunities. What I wanted to talk to you about today and what we have seized up here, or teed up, not seized up, hopefully not, is courtesy of StockCharts.com, is something called the dynamic yield curve. And the dynamic yield curve is simply this particular graph. If you can see, this red line is a graph. I'm going from down the bottom. It's an XY graph. It's 3 months, 2 years, 5 years, 7 years, 10 years, right here, 10 years, 20 years, and 30 years. This is the term structure, and then this is the interest rate on the side of what you would get for treasuries. If you were to buy a 3-month treasury, you're getting very, very little. You're getting a 30-year treasury, you're getting even less, maybe 2.4. What this is referred to as the curve. The steeper the curve, many people think's good for the banks. The flatter the curve, not so good for the economy. Inverted yield curve, many people subscribe, we do, that you're moving into, or you are in a recession. The important thing is what does this yield curve mean to the stock market? So over here is the stock market. The XY axis we show, or it shows the years. So this is back in 1999, 2001, all the way to where we are today at 2016. So when I animate this, and I'm going to go ahead and do that right now, you see this is being activated, and here's the red line moving along the stock market. This is now 1999. So you can believe it, short-term interest rates were up over 4.5%. Yield curve gets flat, almost inverted. People say, hey, something's wrong with the economy. Let's get out of risky stocks. And down we come. And they lock in a higher yield while the market corrects and or crashes. As the market comes down, you'll see the yield curve drop, and this is where the Federal Reserve puts their foot on the proverbial gas pedal, and they drop lower interest rates to steepen the yield curve to get people to loosen up their money and reinvest back into risky assets so that it can stimulate the economy and we can get a rally in the stock market, trickle down economics. And you can see that's what happened. This would have been probably in the days of Greenspan, and where maybe Bernanke. So we get another rally, steepened yield curve, and what we're going to want to pay attention to is what was going on up here in 2016. So right now this is just 2004, 2005. If we can learn from this, and we want to see what was happening up here at 2007, 2008. Interest rates were certainly rising on a short-term basis. You can see the yield curve is actually getting a little bit on the flat side, even though at a higher rate. And we get up here, it gets flat, almost inverts right here. So there were some warning shots here in 2006, 2007, and then we are flat here, no question about it, at a very high interest rate relative to today. We almost go inverted, and now we start to crash. As we crash, you're going to see the short-term rates. Once again, the Fed realizes what's happening. They start lowering interest rates. This is over many months now, if not years. Down the bottom, you're going to see the QE effect, where the Fed, or the active Fed, literally pegs the short-term interest rates at zero, right at the time that wonderful exiting President Obama, who, if you ask himself, did a fantastic job, but interest rates were pegged at zero, which gave for a booming stock market, a rise in asset prices. Why? Because Tina, there was no other place to get a return. Of course, he takes credit for it. He thinks he did everything. Couldn't be further from the truth. This is the reason why. And so we're going to as we advance along, and you can see that if this wasn't pegged, it would probably be at a very flat or inverted yield curve, and the stock market would match the real economy, which is, for all intents and purposes, flat to maybe even recessionary. But because of this distortion, the stock market has risen. Then we get up here, and we'll begin to see this even flatten out further, and we'll get a couple of jogs here. This is where, the Fed had an opportunity to take its foot off the gas and do the right thing and let the market, consolidate. But they weren't going to do that because we had some political things taking place. They had the Brexit in Europe. They didn't want to see that social experiment fall apart in Europe. We had the election here, and they didn't want to see that social experiment fall apart as it has. So I'm going to pause this here in a moment just to comment on where we are. So we're right here, okay? So right now the 30-year is at 2.3 some odd percent. The 10-year is probably right at about 2, and we're still pegged at about 0.25. So the question is whether or not she's going to release this in December. We think that she will, and you can see that we're not, for all the hullabaloo on the Contrarian News Bubble channel, you can hear them. We got a steep yield curve. We're got a steep yield curve. The wrong way in Sana and wrong way Beauvais. You got to buy the banks. You got to buy the banks. They make a ton of money with a steep yield curve. Well, in relative history here for the last 20 years, it's not that steep. And as she raises rates on the short side, is this going to steepen or is it going to flatten out? Is there going to be any real demand here? Our contention is that this is probably going to just flatten out here at just a lower level. And then the other part of it is that even if it does rise a little bit, particularly on the 10-year, it's going to take away the Tina effect. So suddenly, everyone who bought dividend stocks way up here paid a high price for it just so they could get a 2.5% dividend on a high price stock may all of a sudden think, I don't have to accept any of that risk and I can get that kind of yield in safe treasuries. So that has yet to play itself out. But folks, for us, we're not going to be committing new money up here, and with now with the Fed taking its foot off the gas and knowing where the economy is, also the presidential cycle, ask yourself, would Trump rather let this market come back in, consolidate, let's flush out the hot money, maybe experience a little fear in the market, a little fear in the economy, get away from these price distortions. Maybe we come back 25, 30 some odd percent, and 7 or 8 months from now he's able to do his stimulus and tax reform and whatnot, and have some real growth. I think that is the idea, and do it the old-fashioned way. And this will still be managed by his Federal Reserve, but this distortion of pegging it for 8 years, my God, and have generated this in the returns is a bit ridiculous. That's our view. They're going to try to orchestrate what they call a soft landing. Maybe. You can see these sharp gyrations. It may be relative. If we pull back 30-40% in a market that has never even seen a 5 or 10% pullback, hasn't seen a 10% pullback, hasn't seen a 5 for only about a day or two, it still could be a shock to the system. Folks, if you like this sort of information, feel free to follow us on YouTube. Feel free to follow us on Twitter. And we also run a private club where we provide those market videos on a Sunday night on a weekly, monthly basis, and also each and every day based on the swing machine. Wish everyone the best. Now is not the time to be taking on risk in the stock market. Now is the time to be raising cash and looking for opportunities over the next few months, in our view. Best of luck. Be careful.